So, I have to admit, when you sent over the dossier for today's deep dive, I think you set a very specific trap for us.
Oh, absolutely. Right off the bat, I fell for it,
All
too.
right. Because I'm looking at the very first page of the notes you provided, and the
Yeah.
company is called Recode Studios.
hmm
And naturally, when you see the word studios paired with these really explosive financial metrics, you immediately assume something
You
specific.
think media, right?
Exactly. I'm thinking, okay, this is an OTT production house or maybe a VFX company rendering some huge streaming hit like Balaji Telefilms or Prime Focus.
It's the ultimate corporate camouflage,
Yeah.
honestly.
Mm.
The word studios sets this immediate expectation of, sound stages, cameras, maybe some big intellectual property portfolio.
Yeah.
But the pivot here, and this is what makes this specific deep dive so compelling, is that Recode Studios Limited, which trades as Recode on the BSE SME exchange, has absolutely nothing to do with entertainment.
Right. Zero cameras.
Zero cameras, no animation. What they're actually formulating and distributing is affordable luxury cosmetics.
Which is wild.
Yeah, they're a beauty and personal care brand, but they are moving at the speed of a tech startup.
And I think that fundamentally changes the lens through which we have to view this entire dossier you gave us. Because instead of dissecting, subscriber churn on a streaming platform, our mission today is totally different.
Completely different.
We're unpacking how an entirely asset-light, digitally native cosmetics brand is actively trying to dismantle the market share of legacy beauty giants in India.
And doing it really successfully, I mean.
Right. Leveraging influencer marketing, using this totally unorthodox B2B pipeline, and turning what is currently an 80 crore rupee revenue run rate into like a dominant omni-channel empire.
Yeah, that 80 core number is no joke.
No, it's not. But here's the thing that really stuck out to me in the notes. If they aren't operating a traditional manufacturing base, how exactly are they structurally organized to manage, I think it was over 350 SKUs?
Yeah, over 350. And to understand their structure, you really have to look at what they explicitly choose not to do.
Okay, what do you mean?
Well, think about the operational footprint of a legacy cosmetics brand. A huge portion of their capital is tied up in these sprawling manufacturing plants.
Right. Oh, sure.
W-
Mixers, vats, all that heavy machinery.
Exactly. Specialized equipment, raw material supply chains, Recode just completely sidesteps all of that capital intensity.
Wow.
Yeah. They operate across 5 core categories. So you've got face, eye, lip, body, and skincare, and accessories. But their manufacturing is 100% outsourced.
100%. So they don't make anything themselves.
Not a single drop.
Yeah.
They handle the branding, the overarching product strategy, the global sourcing, the distribution network.
Mm.
But the physical creation of the product, that's
Yeah.
entirely handled by third-party suppliers.
That's fascinating. And looking at the sourcing data you highlighted for us, this isn't just local white labeling either. They are routing this globally.
Yeah, the supply chain is really spread out.
Because the notes mention their kajal, for instance, is manufactured in Germany, while other components are sourced domestically in India or from other international hubs. So they're essentially playing the role of an architect, right?
That's a great way to put it.
They draw the blueprints, they curate the neighborhood, they sell the concept to the buyer, but they never actually pour the concrete themselves.
It's an incredibly apt analogy. And that asset-light framework is directly responsible for how fast they can move. The agility is insane.
Because they aren't tied down by machines?
Exactly. When you own the factory, your product roadmap is often dictated by, well, the limitations of your existing machinery.
Oh, like, we have this specific mixer, so we have to make this specific kind of lotion.
Precisely. Or you're worrying about the depreciation schedules of your equipment. But by outsourcing the physical manufacturing, Recode essentially just rents the specialized capabilities of various global suppliers.
Which means they can jump on trends.
Exactly. It allows them to pivot product lines based on real-time social media trends without having to retool an entire assembly line.
Okay, but I got to push back on this for a second because this introduces a really glaring vulnerability.
Okay, let's hear it.
If Recode does not own the formulation machinery, right, and they are relying on, say, this German supplier to produce a high-performing kajal, what leverage do they actually have?
You mean against the supplier?
Yeah. Like, what is stopping that specific third-party manufacturer from taking that exact same chemical composition, bottling it for a direct competitor, and just completely eroding Recode's position in the market?
It's a fair question, and the defense against that supplier-side threat isn't really rooted in trade secrets. It's rooted in brand equity. and speed to market.
Okay, unpack that for me.
So you're entirely correct that a third-party manufacturer could theoretically replicate the physical product for a rival.
Right.
But Recode's moat is built around consumer trust and proprietary performance claims, like highly specific, smudge-proof or waterproof guarantees.
Ah, I see.
The consumer associates those guarantees with the Recode label on the bottle, not the German factory that actually mixed it.
Got it. So the brand is the shield.
Right. And furthermore, their real competitive advantage is their distribution velocity.
Meaning how fast they can sell it.
Exactly. Even if a competitor gains access to the same formulation from that factory, Recode has already built the distribution rails to get that product onto an influencer's Instagram feed and into a customer's cart way faster than some large bureaucratic legacy brand.
So they're basically betting that their distribution network and brand gravity are strong enough to just outpace any copycats.
That's the bet, yeah.
Let's actually look at how that distribution is segmented, because the revenue streams here are split up in a really deliberate way, according to the dossier.
They are, yeah.
Roughly 70% of their revenue is generated through online direct-to-consumer channels. But the critical detail that you pointed out in the notes is that the vast majority of that 70% is routed directly through their own proprietary app and website.
Which is such a highly strategic margin play.
Because they aren't paying a middleman.
Exactly. Now, they do maintain a presence on major aggregate marketplaces like Nika or Amazon, which, is necessary for broad discoverability. You have to be there.
Right. People need to be able to search for you.
But by effectively funneling the core of their digital traffic back to their own platforms, their own app, they are bypassing the 15 to 25% commission structures that those marketplaces typically impose.
And 15 to 25% is a huge chunk of change.
It's make or break. Retaining that margin is essential for a brand operating in the affordable luxury tier, where pricing power is heavily scrutinized by the consumer.
Okay, so that's the online piece. Then you have the remaining 30% of their revenue, which is driven by offline retail and B2B channels.
Right.
And the physical footprint right now sits at 24 stores. I think 3 of those are company-owned, and 21 operate under a franchise model.
Yeah, that's what the notes say.
And they have this stated objective of scaling that to somewhere between 150 and 170 outlets. But the B2B strategy, this is where the operations get genuinely fascinating to me.
The master classes.
Yes. Because usually a cosmetics B2B play involves, aggressive negotiations for shelf space in large department stores.
Right. Fighting for the end cap at a retailer.
Exactly. But Recode has engineered this institutional masterclass system that essentially bypasses those traditional wholesale gatekeepers altogether.
It's brilliant. The masterclass initiative is arguably the most efficient customer acquisition loop in their entire operation.
Really? More than the influencers?
In the B2B space, absolutely. Recode actively orchestrates training sessions for professional makeup artists and independent salon owners.
Okay.
The notes indicate they have executed over 500 of these institutional masterclasses.
Wow, 500.
And they aren't just selling product at these events. They're providing professional upskilling using Recode's specific skills.
So they're teaching them techniques, but the catch is, hey, we're using Recode eyeliner to do this.
Exactly.
And the downstream effect of that has to be incredibly potent, because once a professional makeup artist is trained on the mechanics of, say, a Recode primer or foundation, and they validate the performance under professional conditions like, I don't know, hot wedding lighting or extended wear for a bridal shoot, they instantly convert into bulk B2B purchasers.
You nailed it. They start buying the commercial kits to utilize on their own client base. And that specific pipeline is driving a significant portion of that 30% offline revenue block.
And I imagine it solves a pretty major trust deficit for a relatively new brand, too.
Oh, completely. Think about it from the consumer's perspective. When a consumer sits down in a salon chair, they implicitly trust the expertise of the professional standing over them.
Right, they're the expert.
So if the professional selects a Recode product instead of some legacy luxury brand, it serves as an incredibly powerful, unscripted endorsement.
Like a real-world influencer.
Exactly. It transforms the salon owner into a decentralized distributor and a highly credible brand advocate, which is, frankly, far more persuasive than a static billboard on the highway.
It effectively weaponizes the professional tier of the industry to drive consumer-level brand awareness.
It really does.
But that brings us to the actual consumer demographic they are targeting because, the Indian beauty and personal care market is projected to reach $30 to $35 billion by 2027.
It's an enormous market.
Highly saturated, intensely competitive, everyone wants a piece. So where exactly is Recode finding the oxygen to grow to an 80 crore run rate? Like, why haven't the established legacy conglomerates already occupied the space Recode is playing in?
Well, to answer that, we really have to look at the specific stratification of the Indian cosmetics market.
Okay, lay it out for me.
Recode is entirely focused on the mid-premium segment. That's a subsector valued at approximately $15 to $18 billion.
Okay.
And their target demographic is highly specific. They are going after women aged 16 to 45, distributed across Category A, B, and C cities.
So not just the major metros.
Right, not just Mumbai and Delhi.
Yeah.
Tier 2, Tier 3 cities as well. These are consumers operating with lower middle income purchasing power, yet their aesthetic expectations are benchmarked against international quality standards.
Ah, I see. So there is a structural gap in the pricing architecture of the market.
Exactly.
You have the lower tier, highly accessible domestic brands sitting at a price point of around 300 rupees.
Mm.
And on the opposite end, you have the premium global labels demanding significant premiums. So Recode is positioning itself precisely in the vacuum between those two extremes.
That's exactly it. Let's anchor this with the specific product example from the sources you provided because I think it perfectly illustrates the strategy.
Yeah, the primer, right.
Right. Consider a foundational product like a makeup primer. A consumer looking at a premium global brand, such as MAC, is going to encounter a price point in the vicinity of 1,800 rupees.
Which is pretty steep.
It is. Now, the 300 rupee domestic alternative simply cannot compete on formulation stability or wear time. It's just not going to hold up.
It's going to melt off your face in 3 hours.
Exactly. So Recode enters that exact scenario, offering a professional-grade, comparable formulation for 800 rupees.
Wow. So less than half the price of the premium brand, but with the professional validation.
Exactly. It forces the consumer into a very compelling arbitrage scenario.
Yeah, I mean, if you are accustomed to the performance of an 1,800 rupee legacy product, and suddenly this digitally native brand offers identical utility, smudge-proof, waterproof, professionally validated by your salon at less than half the capital outlay.
The friction to switch is remarkably low.
Now, why wouldn't you switch?
And the broader market data supports that exact consumer behavior. Here's a metric from the notes that truly contextualizes their growth trajectory.
Okay, let's hear it.
Overall, cosmetics penetration among urban Indian women hovers around 25 to 30%.
Okay.
However, penetration specifically within this mid-premium 800 rupee tier segment is less than 10%.
Wait, really? Less than 10%?
Less than 10%.
That is a staggering inefficiency in the market.
It is.
I mean, a sub 10% penetration rate implies that roughly 90% of a 500 million woman demographic remains entirely untapped by this specific price to quality proposition.
Yep, it's wide open.
But that also raises a pretty critical strategic question for me.
Sure.
If there is this glaring vacuum in the mid-premium tier, why wouldn't a legacy brand just aggressively discount their secondary lines to capture that market share? Like, why doesn't L'Oreal or Lakmé just drop their prices to 800 rupees?
Because it comes down to the mechanics of brand dilution and their entrenched overhead.
Brand dilution?
Yeah. A legacy luxury brand cannot suddenly slash a core product from 1,800 rupees to 800 rupees without irreparably damaging its premium positioning.
Ah, right. Why am I paying 1,800 if it's suddenly worth 800?
Exactly. They would cannibalize their own higher margin sales.
Yeah.
Furthermore, their entire supply chain, their real estate portfolio, their corporate overhead, all of it is calibrated for luxury margins.
Oh, I see. Their factories are too expensive to run at an 800 rupee price point.
Precisely. Recode, operating with a lean, outsourced, asset-light structure, is structurally engineered to be profitable at the 800 rupee mark in a way that a bloated legacy conglomerate simply isn't.
Okay, that makes total sense. So Recode essentially has a structural cost advantage that allows them to defend that mid-premium territory.
They do.
But, structurally defending a price point only matters if the consumer actually knows you exist in the first place.
Right.
And breaking through the noise of legacy marketing budgets requires serious capital allocation. Looking at the dossier, it shows Recode dedicating roughly 20% of its top-line revenue to marketing.
Which is aggressive, but fairly standard for a D2C brand.
True. What stands out, though, is the composition of that spend. They are allocating 12 to 15% of their revenue exclusively to influencer campaigns.
Yeah, influencer networks function as the primary distribution channel for their brand narrative.
So no TV commercials.
Exactly. They have effectively bypassed traditional print and television advertising, opting instead to rent digital real estate directly on the target demographic social feeds.
Right on TikTok or Instagram.
Yeah. And they utilize this highly targeted distribution to push product concepts that legacy brands are traditionally way too slow to adopt.
This is a fun part of the notes. You highlighted their position as a first mover in highly specific niche aesthetics in India.
Yeah, the neon stuff.
Right, like matte neon eyeliners and colored mascaras, which, are trends that iterate rapidly on social media but require a production agility that legacy brands just totally lack.
They can't keep up.
A large multinational might require, what, an 18-month lead time to approve, formulate, and distribute a neon product line.
Easily 18 months, yeah.
And by the time it hits the physical shelf, the digital trend has completely evaporated. No one cares about neon eyeliner anymore.
Exactly. Recode's outsourced manufacturing allows them to compress that entire product development lifecycle.
How fast are we talking?
Well, they identify a microtrend via their influencer network, right?
Mm-hmm.
They relay the specifications to a specialized supplier, and they initiate digital distribution while the trend is still peaking.
That is just ridiculously efficient.
It is. But, the true catalyst for their current brand velocity wasn't merely a neon product launch.
Right, it was the TV appearance.
Yes. It was a very specific, highly public television appearance. Back in 2022, founders Dheeraj Bansal and Rahul Sachdeva took the company onto Shark Tank India.
Okay. And the outcome of that pitch is a total masterclass in the unintended consequences of media exposure.
Oh, it really is.
Because, if I'm reading this right, the founders were actually rejected by the judging panel.
They were.
They walked away without securing a deal, ostensibly due to, valuation disputes and perceived conflicts of interest with the investors' existing portfolios.
Sugar cosmetics specifically.
Right, right. And in a traditional business context, a public rejection from prominent venture capitalists on national television would be a pretty negative signal to the market.
You would think so. It would normally kill a brand's momentum. Yet, the market reaction was entirely inverted.
Oh, so?
The consumer base was suddenly exposed to their unit economics, their profitability, and the underlying logic of the mid-premium strategy.
So the viewers watched the pitch and went, wait, this is a great business.
Exactly. The transparency of the pitch generated this wave of organic brand trust that far exceeded the value of any potential venture capital injection.
That is incredible.
The financial metrics before and after the broadcast are just stark.
Give me the numbers.
Prior to the appearance, their valuation was hovering in the 50 to 100 crore range.
Okay.
Within months of that rejection airing, the market effectively repriced their valuation to 240 crore.
Wow.
Based solely on the surge in consumer demand and brand equity from being on the show.
So they more than doubled their valuation without giving up any equity to the sharks.
Exactly.
It proves that sometimes the sheer magnitude of the top-of-funnel exposure is infinitely more valuable than the actual term sheet.
Absolutely.
But, converting a viral television moment into sustainable retail revenue requires serious retention mechanics.
It does. A spike is just a spike if they don't stay.
Right. If you just have a spike in one-time novelty purchases, your customer acquisition costs eventually just crush you. But the dossier points to a 40% month-on-month repeat purchase rate.
Yeah, that 40% retention metric is the engine room of their profitability.
That's a huge number for cosmetics.
It really is. And it validates the quality of the outsourced formulations we were talking about earlier.
Oh, I see. Because the product actually works.
Exactly. Consumers might buy a neon eyeliner once because they saw it on television, but they do not return the following month to replenish an 800 rupee primer unless the product fundamentally performs.
Right. If it's garbage, they buy it once and never come back.
Exactly. And because Recode commands 72% of its online sales through its proprietary platforms.
The app and website.
Right. They retain absolute ownership of the customer data generated by those repeat purchases.
Which gives them the ability to deploy highly targeted zero CAC remarketing campaigns.
Zero customer acquisition cost, exactly.
They don't have to pay a marketplace algorithm to re-engage their own customer. They just send them a push notification.
Exactly. It's free marketing.
But, we have to acknowledge the existential risk embedded in this strategy, right?
Oh, for sure. It's not all sunshine.
The management team themselves concedes a profound dependence on social media algorithms.
Yeah.
If an arbitrary change in a platform's code drastically suppresses organic reach, or if the cost of influencer inventory suddenly spikes, Recode's primary top-of-funnel acquisition engine could stall instantly.
It's the defining risk profile for any digitally native brand. You are effectively building a highly profitable storefront on rented digital land.
Rented land. That's a great way to frame it.
Yeah, Instagram or TikTok could change the rent at any time. And that inherent instability is precisely why they are accelerating the deployment of physical retail infrastructure.
Ah, going back to the stores and the master classes.
Exactly. They are doubling down on the decentralized B2B masterclass network and the franchise stores because those physical touch points serve as a hedge against algorithmic volatility.
Makes total sense. Okay, let's transition to the financial realities because we need to see how this asset-light agility and influencer-driven acquisition actually translates to the income statement.
The numbers are pretty wild.
The top-line trajectory is undeniably aggressive. We are looking at revenue scaling from 37.2 crore in FY24, stepping up to 48 crore in FY25, and then violently accelerating to an 80 crore run rate for FY26.
Yeah.
That is a 67% year-over-year expansion.
The top line growth is impressive, but honestly, the bottom line translation is what demands attention.
The profits.
Right. They aren't simply buying revenue through unsustainable discounting, which is what a lot of D2C brands do.
Very true.
Their profit after tax, the PAT, expanded from 3.15 crore in FY25 to 11.21 crore in FY26.
That's a huge jump.
It represents a 260% acceleration in pure profitability.
Okay, so the margin profile clarifies exactly how efficient the operation has become. They are reporting EBITDA margins pushing 20% for FY26.
Which is very healthy.
But the metric that truly stops you in your tracks is the return on equity.
Oh, yeah.
An ROE of 78% is a severe anomaly in the retail sector.
It's almost unheard of for a company selling physical goods.
Right. But if you connect the dots back to our earlier discussion about the asset-light structure, the mechanics of that 78% become very clear.
Exactly. Walk through it.
Because they have actively chosen not to deploy capital into factories, heavy machinery, or sprawling industrial real estate, their equity base is exceptionally lean.
They don't own much physical stuff.
Right. So when you drop an 11.21 crore profit onto a minimized equity denominator, the resulting ROE looks astronomical compared to a legacy brand that is dragging the dead weight of physical manufacturing assets.
It's the mathematical advantage of the outsourced model operating at scale.
Yeah.
And to sustain that momentum, the company executed an IPO on the BSE SME exchange, and they successfully raised 44.59 crore.
Okay, so they went public to raise capital.
Right. And the allocation of that capital is highly instructive regarding their forward strategy.
Where's the money going?
Well, since they do not require capital expenditure for manufacturing facilities, the proceeds are strictly earmarked for operational leverage and logistical infrastructure.
Makes sense.
Specifically, 19.50 crore is directed toward fortifying working capital,
Okay.
and 5.74 crore is dedicated to the establishment of a strategic warehouse facility in Ludhiana.
Ludhiana. Okay, the geographical placement of that Ludhiana warehouse is a critical piece of the puzzle, especially when you look at their stated growth mandates.
Oh, absolutely.
They're targeting a formidable 50% plus revenue growth for FY27, with expansion vectors pointed towards South, Northeast, and Central India.
Very ambitious.
But the real strategic pivot here, according to the notes, is their aggressive push into modern trade and quick commerce platforms, networks like Blinkit.
And that is a whole different ballgame.
Right. The quick commerce ecosystem requires a completely different logistical architecture than traditional D2C shipping.
Completely different. The consumer expectation compresses from, a 3-day delivery window to a 10-minute delivery window.
A 10-minute delivery window for eyeliner.
Yeah.
And the unit economics of quick commerce are notoriously brutal. I mean, we have watched countless well-funded startups immolate their balance sheets attempting to subsidize rapid delivery.
It burns cash so fast.
So for an affordable luxury cosmetics brand to maintain that 20% EBITDA margin while absorbing the friction of 10-minute delivery, the back-end logistics have to be flawless.
And that is the exact rationale behind the capital allocation for the Ludhiana warehouse and the subsequent expansion of a localized dark store network.
Okay, connect those dots for me.
The quick commerce model is only financially viable if your per-unit logistical costs are ruthlessly minimized.
You can't be shipping it across the country for a 10-minute order.
Exactly.
Yeah.
So by utilizing the IPO capital to position inventory nodes significantly closer to the end consumer and managing those regional hubs internally, Recode aims to mitigate the margin compression typically associated with rapid fulfillment.
So they're basically attempting to construct a physical logistical network that operates with the same velocity and precision as their digital marketing engine.
That's the goal.
But, hyper growth in a physical retail environment inherently generates operational friction.
Always.
You do not scale revenue by 67% without stressing the underlying architecture of the business.
Something always creaks.
Exactly. When we dig into the balance sheet, what is the actual friction point? Where is the Achilles heel in a company posting a 78% ROE?
The primary friction point is a pronounced liquidity mismatch.
Okay.
If you evaluate the balance sheet purely through the lens of leverage, it appears incredibly robust.
Well,
The company operates with a net debt position of merely 4.88 crore.
meaning they're essentially unburdened by debt servicing obligations.
Right, they aren't paying huge interest bills every month.
Which provides significant operational flexibility. However, the cash position is where the narrative gets really complicated.
Yes, it does.
Despite booking over 11 crore in net profit, the data indicates their actual physical cash reserves sit at a razor-thin 1.32 crore.
It's tight.
So you have a highly profitable enterprise on the income statement, but an extraordinarily tight cash position on the balance sheet.
And this is the textbook working capital strain associated with aggressive retail expansion.
Specifically physical retail, right?
Yes, particularly when transitioning into physical retail and modern trade channels. The cash generated by the operation is being immediately absorbed back into the business cycle.
So it's not sitting in a bank account.
Exactly. It is locked up in escalating inventory requirements. Think about the sheer volume of physical product needed to adequately stock a growing network of franchise stores and newly constructed regional warehouses.
Right. They have to fill the shelves before they can sell it.
Exactly. Furthermore, it is tied up in extended accounts receivable.
Ah, the friction of trade credit.
Yep.
Because when Recode sells a massive volume of SKUs to a modern trade partner or a franchisee, they book the revenue and the profit immediately on the ledger. But the physical cash settlement might be delayed by 30, 60, or even 90 days, depending on the negotiated credit terms.
Exactly right.
So the 11.21 core profit exists on paper, but the actual liquidity is temporarily frozen in the form of warehouse inventory and retail IOUs.
It demands meticulous cash cycle management. Now, it is crucial to contextualize that this liquidity mismatch does not indicate a solvency crisis.
Right. They aren't going bankrupt.
No, their minimal debt profile shields them from the immediate threat of insolvency. However, the strategic risk is one of capital adequacy.
Will they have enough cash to keep growing?
Exactly. The defining challenge for management in FY27 will be their ability to optimize inventory turnover and accelerate cash collection.
Because if they fail to convert those receivables into liquid cash rapidly enough to fund their ambitious 50% growth target,
They may be forced to seek external financing.
and raising additional equity to fund working capital shortfalls inevitably results in the dilution of existing shareholders.
Exactly. That is the critical risk for the investor base. It is not about bankruptcy. It is about protecting the equity value from dilution.
Right. And that financial risk is really compounded by the operational risks inherent in their 100% outsourced model.
Oh, absolutely.
We discussed the agility it provides earlier, but it also creates severe supplier concentration risk.
A huge risk.
If that primary manufacturer in Germany encounters an unforeseen labor strike or a prolonged shipping disruption or a degradation in quality control, Recode cannot simply command an internal factory to increase output.
They have no internal factory.
Right. They are entirely exposed to the operational stability of their third-party vendors,
And a disruption in the supply chain translates immediately to stockouts at the retail level.
which is deadly in retail.
It is. In the hyper-competitive mid-premium beauty sector, consumer patience is practically non-existent.
Oh, yeah. If a customer intends to replenish their preferred Recode foundation and encounters an empty shelf or an out-of-stock digital cart, they will instantly defect to a competitor.
Without a second thought. And the market is heavily saturated with aggressive challengers.
You've got domestic titans like Nykaa and Honasa's Mama Earth, plus this influx of aggressively priced K-beauty imports flooding the market.
Exactly. Recode's growth thesis relies on maintaining flawless inventory availability in a landscape where brand loyalty is heavily subsidized by immediate convenience.
And, layering on top of the supply chain liquidity concerns is the reality of key person risk.
Which is substantial here.
Yeah, post-IPO, the promoters maintain a dominant 65% equity stake in the company. The entire operational playbook, the community-driven B2B strategy, the agile trend identification, the influencer network relationships, it's all deeply entwined with the strategic vision of the two
It's
founders.
their baby.
Right. Minority shareholders have functionally zero leverage regarding the strategic direction of the enterprise. If the founders were to implement a flawed strategic pivot, the structural safeguards for minority investors are negligible.
It is a high-conviction play on the execution capabilities of the founding team. Now, they have demonstrated an exceptional ability to navigate the transition from a niche D2C player to an 80 crore omnichannel entity.
Very true.
But the complexity of managing a fragmented third-party supply chain while simultaneously executing a quick commerce rollout and expanding a physical franchise network that requires a level of operational maturity that is significantly more demanding than their initial growth phase.
It's a whole different game now.
It really is.
It is a remarkable evolution, though, from the initial misconception of our deep dive. I mean, we opened this dossier expecting the metrics of a media studio.
And instead, we unpacked a fiercely aggressive cosmetics brand.
Right. One that capitalized on a public television rejection to build an incredibly capital-efficient omnichannel retail machine.
Yeah.
They have proven that there is substantial, untapped enterprise value in democratizing professional-grade quality for the mid-premium Indian consumer.
I'd say Recode serves as a highly effective case study for the modern architecture of retail.
In what way, specifically?
Well, they validate the thesis that you do not need to command the physical means of production if you can successfully monopolize the digital attention of the consumer and build a frictionless distribution network.
Attention is the new factory.
Exactly. However, defending that asset-light model against heavily capitalized incumbents will demand absolute precision in working capital management and supply chain logistics.
Which leaves us with a really fascinating strategic paradox to consider as we close out this analysis.
Ooh, what's that?
Well, think about it. Recode built its momentum by utilizing external influencer networks to distribute third-party manufactured formulations.
Right. It's a highly efficient asset-light arbitrage.
Yes. But as the friction to launch a digital brand continues to approach zero, what prevents their own distribution network from becoming their primary competitor?
Oh, that's an interesting thought.
Right. What happens to Recode's market share when a prominent beauty influencer decides to bypass the Recode label entirely, engages directly with that exact same specialized manufacturer in Germany, and launches an identical white label formulation directly to their own audience?
They could totally do that.
Exactly. In a purely asset-light ecosystem where the factory is available for rent to anyone with an audience, is the concept of durable brand loyalty fundamentally at risk?
That is a great question to leave on.
It is. Thank you for sending over such a complex, layered set of sources for us to dissect. This has been a truly compelling deep dive. We will catch you on the next one.